there's a bit of a myth out there that I think that people think that you need to take on debt to build your credit score before you get a mortgage. Your credit score is perfect until it's not. If you've always met your obligations, then you'll have a good credit score, have good cash flow, save money. Your credit score will not be an issue.
You're listening to the Young Minds Podcast.
1, 2, 3, listen.
Welcome to the Young Minds Podcast, hosted by Burke Britain Financial Partners. This podcast helps young adults build confidence and clarity when it comes to money. Empowered by youth, inspired by experience. We know that navigating the world of finance in your late teens to 20s can feel overwhelming, whether it's understanding your first payslip, learning how to invest, managing student debt, or just trying to save without missing out on life, because believe it or not, it is actually possible.
That's why this podcast is here, to make finance more accessible, more understandable, and way more relevant to your life right now. Each episode will break down key financial concepts, give you practical tips you can actually use, and have real conversations about money. From budgeting and credit scores to purchasing your first home, we will cover it all.
As university students coming to the end of our degrees, we created this podcast not because we have all the answers, but because we're asking the same questions you are. Each episode will be accompanied by a financial advisor from the Burke Britain Financial Practice to provide insight and guidance in the topics to come. No confusing words, no lectures, just honest insight to help you make smarter money moves now and in the future.
So whether you're studying, working, or figuring things out, you're in the right place. Accompanying us today, Ben Kemp. Welcome back.
Thanks, guys. Thanks for having me. I've written down no jargon, no confusing terms, because I think last time I got a bit of feedback, a bit over the top. So I'll be better this time, all right?
Just keep it simple, mate.
No worries. No worries. Thank you for having me anyway.
So one of the opening hooks we would like to add is, ever wondered why debt feels like a heavy backpack you can't take off? What if managing it was simpler than you actually think? So maybe just to start, Ben, why do so many young people fall into debt without actually realizing it?
I think it's for young people especially, but it can happen to people at all different phases. But I suppose life is probably the cliche answer, but you have a lot of life events, and people go through different phases of between jobs, trying to get jobs, getting them set up in the world. There's also the risk of medical expenses or things around them that they can't control. So there's a range of things. I think one of the big parts is probably lack of education, that a lot of people coming through school, and as you guys, while you're doing this, is that people don't really learn what is a loan, what is a debt, what do I have to do to service that, pay it back. So a lot of people, it's just simply they just don't have education around understanding when they're actually even taking a debt or a loan. They don't, because it's not sometimes even branded as that. So again, it's confusing. And people without education obviously find ways to fall into it.
Mm-hmm. Based on going through life and going through the motions, you get to sort of our point in life, and just about everyone's got something called buy now, pay later. Can we touch on what that is, how people get caught in the scheme of it? Yeah,
it's interesting because for me, it sort of burst onto the scene during COVID, which I think it was probably around just before that, but that's when it obviously exploded. So again, as the name of it suggests, which is probably one of the rare times where the name actually suggests what it is, it's buying it now and it's paying it off later. So in simple terms, it's buying on credit. You would have seen the likes of Afterpay, ZipPay, PayPal, some of these different providers. There's lots of different offerings out there that have it. At the core of it, it's where someone decides to pay off a good in installments, generally speaking, across 3 or 4 payments. Sometimes it can be different terms as well. But basically, it's a mini credit card, but it has very low or no assessment or introduction period to learn, does this person actually have the means to pay it back? So initially, it might look really low cost, but most like most of those schemes, if you miss a payment or something, the terms and the penalties are really exorbitant.
How does interest come into buy now, pay later?
Well, it generally doesn't. I don't think. I haven't used it myself actually, but it doesn't generally hit you unless you miss a payment. So this might be an example that people may or may not remember. Maybe this will make me sound old. If you ever see like Harvey Norman advertising like a 24 months interest-free buy now, like that was essentially like a buy now, pay later scheme. Mm-hmm. The issue was if you didn't meet all payments by the end of the 24 months, it would be like a 20% penalty. So that was just like an interest charge. So it's very similar on the buy now, pay laters. It's sometimes no cost if you meet your obligations. What they're dining out on is people not meeting their obligations and then getting really penalised. And those companies make money because they're likely getting a clip of any of the margin, because it's what they've done is enable people to buy products they couldn't afford, which is what debt is. It's giving you a means to buy a product or good or service or something that you can't actually fund, or you could, but you choose not to. So that's why they make money, is that it accelerated retail during that period because it gave more people buying power.
Mm-hmm. So as like a wrap up on buy now, pay later, would you say it is something people should be using, or it isn't, or is it?
I've seen rational people use it and to a good effect. But again, it's about discipline, and I suppose it always comes back to the broader question of why are you using it? Do you need to use it? And sometimes maybe yes, there's a very small benefit of a matter of a few cents potentially on what it could have been otherwise. But sometimes the simplicity is the best outcome too.
Mm-hmm.
Cool. Maybe to touch on now credit cards. So maybe if you could just start with explaining firstly what is a credit card and maybe the difference between a debit card and a credit card.
Good question. So I'll do that first part. It's probably the easy one. A debit card is essentially spending your money, your savings that you've got in an account, and you're making a debit from your account to pay for the good. A credit is where you don't have the money yet. You're paying for the good with credit and that you will pay back to the bank. So the bank is the one who's giving you the money to allow you to make the purchase, and then you will pay that back to them when you feel like it, or on their terms that have been met. So credit cards are interesting. They have changed a lot, I think, in recent years, probably for the better. I remember when I was at uni, which wasn't that long ago, people at uni would have credit cards often because their bank would give them to them for free or without any servicing checks. I think now, speaking from my own experience of seeing it, is there's a lot more protocol and rigor that goes into checking that people should have a credit card, but you can still access them. And they're dangerous because they're high. They've got a really high interest rate because they're allowing you, they're not verifying what you're purchasing. Like you could be gambling, you could be going out drinking, partying, holidays, you could do anything with it. Like sometimes people are using it for necessities like groceries and things too. But essentially, again, the bank makes money when people fail to meet their obligations and fail to pay it off in time. So more often than not, people start off really disciplined and they pay it off every fortnight, every month, whatever the period is. And then things get big on them and, oops, we missed a payment. And as soon as you do that a couple of times and then there's a balance sitting there, they're super expensive. You're talking sort of 15% plus interest rates on these things. So it's super expensive debt. I'm not an anti-credit card person, but I think they're only for the right people. And sometimes, again, it's a situational thing, and sometimes businesses will use them and sometimes people use them for points and things. And I understand the points argument and the benefits, but again, the points are only worth it if you're paying the thing off and you're not getting charged interest. Otherwise, you're just paying for it indirectly.
Alrighty, the next one that we had, so credit cards you're borrowing through a bank. We've also got personal loans in the form of family and friends lending. So for clarity's sakes, this is literally how it sounds. You're borrowing money from your friends and family. The question I've got around that is, how do you keep your family and borrowing that money? How do you keep the relationship stable? How do you stop it from clashing? When should you be introducing like a written agreement as such?
It's definitely one of those dangerous things when you're mixing, especially friends or family and money, like in any, whether it's business or otherwise, or any financial obligation that merges different parties together. As much as you might be aligned, things can change over time, and other parties can come to have impact on that too. I think if you're going to do it, then you just have to set the terms, like you've mentioned, around interest, timeline, repayments, expectations. It just has to be documented. Now, probably depending on the scale of that debt, you probably want to potentially even get legal, involvement, and they can contract it out properly if you're talking about, significant sums of money. I suppose, again, the boring part of me just goes back to why, like what's led to that? Like, why are you borrowing money from family? Now, often that's a common thing when someone might be trying to buy their first home or even enter a business or something. Like, there might be reasons behind it. It's probably all the more reason to be documented and regimented and actually detail what is the expectations from all parties. It does need to be a contract. I know that can feel a touch awkward, but it's a hell of a lot better than when it goes to shit and everyone hates each other and they're arguing about money. And sometimes it's not even a big amount of money. Like, it might be a few $1,000s in the scheme of a relationship that's maybe, family or decades worth of friendship. So I think it just has to be clear. All parties have to know where they stand. They have to have the understanding of the terms. They need exit plan. Again, I think it's something to be avoided. Like, I think it where possible, be avoided, and where done, it needs to be done with good consideration and openness from all parties on the way in.
What would you suggest people do if plans change? Like, you've set up this agreement, you've put it in writing, but it gets to, halfway through and you're like, oh, something's changed here. What do you do then?
Well, I think that's where this might sound weird. You sort of need to try and preempt that. Like, you need to go, okay, it might sound crazy at the start, but if one party needs to exit this arrangement, there's a 90-day notice period or something. Like, you have to build those things in. And again, this is probably more so talking about where there's a reasonable scale of funds, or there's potentially assets that are not liquid that can be cashed out as well. But again, you just need, that's why it gets tricky, is that you need to sort of try and plan for all of these circumstances. And maybe it's a 1 year notice period, which may be way too long for the person if they've hit hardship. So, again, I think it just needs to be done with real high levels of caution. And you really need to explore most other options before you do it. The problem we see is where people want to help and they just do it like really loosely, and it just unravels, unfortunately. And it creates way more issues and turmoil than it was worth from a financial gain.
Mm. And in that respect, when would you say that it's, the better option is to say no if someone comes to you to ask for money?
Well, if you know them and you have a bit of an idea around their financial literacy and their capacity anyway, you go, why? Like, okay, so if someone's coming to me to ask for money, like, why is that? This is what I would do in my head, go, oh, that's a bit weird. Like, they're working, or, oh, I wonder why they aren't talking to their bank about that, or why aren't they doing that? Like, you would sort of got to do a bit of a personal risk assessment of that for a start, because you need to know who you're getting into bed with in that sense. Like, who are you actually entering a financial arrangement with? So, again, we also see it a lot. Like, we see it heaps, and we help families assist their kids all the time. But again, what we're doing is really drive process, structure, often driving a loan agreement to be written to protect parties around it. And it can feel a bit awkward, but it's worth it. It's worth it for the clarity's sake, and everyone knows where they stand, and there's no disagreements because it's just a fact. So yeah, I think there's something that will always happen, and they will always cause conflict, but they can be done well also.
Mm-hmm.
So in regards to medical debt now, Australia has Medicare, but medical debt can still happen. So maybe if you could just touch on, like, how does it still happen?
So the Medicare system in Australia essentially is the system that provides the healthcare funding for everyone. So it's what actually, pays for the doctor's visits or pays for operations and things. It's the system that supports people. And again, it's sort of partially, I suppose, to an extent, sort of means tested too. But it's a controversial system because people always want more and other people argue it's cost too much. We have a much better medical system and payment method than most countries. Like, if you talk about the US, people, it's crazy expensive, and people hear stories and read stories about that. But in Australia, most of the time things are covered. Sometimes there is still a gap, so people might have private health insurance, but they may still need to fund a component of that, even if they are insured for it. So again, it's a complex one. I think the key thing with medical debt is trying to avoid it, and what I mean by that is that we always want people to try and have a buffer. Like, we're talking about sort of short-term fixed loans here, like buy now, pay later, credit cards, personal debts, things like that. If you've got a buffer of funds available, you should be able to use your cash holdings and things before you need to even consider debt. I understand there's definitely circumstances where people do have to look at debt for medical expenses, but again, especially if it's something that's like that you're having done by choice, like, you really need to question the validity and the need for that. I know that sounds horrible, but I've seen people doing elective surgeries and I'm trying to think of the right word. Like, basically, I don't know, I'll use the example of, I've had clients in the past and they were young people where they wanted to have a boob job, but they didn't even have the money available for it. They were considering servicing that with debt. And from a financial perspective, it just was absolutely crazy. But that's what they wanted to do. I mean, you had to go through that process of telling them their options and explaining, like, why I think that's a really bad idea. But for them, they valued it highly. So again, I couldn't understand it. But again, if you're doing it for cosmetic reasons, that's probably something you want to be definitely avoiding.
Next one we've got here is student loans. So what's a HECS debt? How do you get it? How do you work around it?
again, it goes back to that point of where some people end up in debt without realizing it. They don't even really view the HECS system or the help debt system as a loan. But essentially, when people go to university, most Australians are eligible to put their education costs onto the HECS or help system, which is essentially a loan system that sits with the government book, and they fund it to the uni. And then when you're into the workforce, earning over a certain threshold, they'll automatically deduct payments at a ratio. So as you earn more, they take more. So I think, I should check the numbers, but I think it's around 50 to 60,000 is where the minimum is, and you start to then have small portions of your pay deducted on top of your tax, and it goes to the loan system automatically. So some people choose to pay it off quicker. Some people choose to prepay their student expenses. Now, it really does depend. I'm certainly not anti the help debt system. I think that it gets people into study, gets them into really good jobs, and they should be able to pay it back relatively quickly. Obviously, there's examples, and there's always horror stories about these things. But again, you've got to go in eyes wide open to, I am borrowing money to study. If I study 4 degrees, I will have 4 times the amount of student debt that someone who did one course will have, and that's where they can get big, and then they do need some attention later on. But again, they're essential thing. They get people upskilled and into jobs. So I think it's a fair system. Again, it cops a bit of a bad rap at times too, though.
Would you say it's something that people should be paying off early, or just leaving it and pay it off as your threshold goes up?
It depends. It really does depend. A lot of people ask that. Now, the interest cost on it is very low, and that's been changed in recent years to be even lower, and there's protections because there was a couple of years where it indexed quite heavily because it was tied to inflation. They've changed that now, and it's got a lower end tie to it. So from an interest cost perspective, it's far lower than bank debt or like home loan rates even. So from a pure debt, if you line up all your debts, which one should I pay off first? It doesn't make sense to pay it off. But in saying that, because it's an obligated payment that comes out of your pay every week, fortnight, month, it does reduce your cash flow, and it reduces your serviceability potentially on loans. And I know the bank has changed how they assess that, but it doesn't matter what they assess. The fact of the matter is that if they're taking money out of your pay each week or fortnight, you've got less cash flow. So you need to be aware of that. So sometimes when we're talking about family loans and things, sometimes what I'll find family members will actually pay the HECS debt out in a lump sum to remove it as an obligation, then get the child to pay them back directly. Because what it does is it clears that debt off them. So it helps the family they want to help them, helps them get rid of the debt, removes the payment, frees up their cash flow, and then they use that cash flow to help pay back their parents on their own terms, which might be at a 0 rate or something. Again, I've seen it done many different ways. You just have to get advice on it. It is a little bit of a quirky one for different people as well.
All right, moving on now. So maybe if you could just touch on what are some of the smartest first steps to take when you do feel overwhelmed by the debt that you have?
I think if you're feeling that way, that you've just got to actually do something, which might sound very vanilla, but you just need to speak to someone, like speak to the debt providers who's giving it to you, speak to a broker who might be able to look at consolidation of debt, speak to financial advisors. I think we get a good view of it because we can look at it and give you some holistic thought. So it might not be just saying like, oh, you should move that debt to there or something like that. We might say, look, what's your broader plan? What's your cash flow look like? How do you think you will actually pay this down? And then put some steps in place. Then maybe working with a broker. I have had a few clients recently. They've had a few emergency expenses or some budget blowouts on renos and things, and they've ended up with a bit of debt that just needed to be consolidated, cleaned up, and then mapped out. Long term, they'll be fine, but in the short term, it gives them great stress. So you just got to consolidate it, clean it up, make a plan, pay it off. And again, you just got to talk to people. As soon as you feel like debt's concerning you, then you should speak to someone probably, because when you're in that state of mind, you don't necessarily make good decisions either, and you probably don't make good rational thought around what you should do with your debt. Often, I always say, just do that stock take yourself. Like if you've got 4 debts, let's say you've got buy now, pay later, credit card, home loan, and student loan, like line them up, look at the interest rate, look at the payment terms, get that together. Quickly, you'll probably realize that whatever one's at the highest interest rate, I probably should direct my funds to first of all. But again, still seek advice, because there's maybe ways that you could merge 2 of those debts together and bring down the overall interest rate and actually get through it even quicker again. So get the advice. There's people who specialize in this stuff all the time. There's no shame in it. It happens to lots and lots of people. And the ones who deal with it quickly end up being fine. The ones who don't end up in the hole for years and years.
Thank you. Then the last sort of topic that we've got here is how can managing debt today set you up for a financial freedom tomorrow?
Again, I think maybe just reflect and say that you've got the client, those people we're talking about who've got issues and we need to do some tidy up. Then there's others who really are looking to use debt to grow their wealth and to manage it responsibly. Debt is almost as across the board. Like you wouldn't find too many people that don't have a loan or debt of some description. Even people who've paid off their home and are well into retirement, they may still have a redraw facility or a credit card or something. So debt is not a bad thing. It's just about how you use that debt. And I think getting your head around debt early on and trying not to have what we would deem bad debts is key. So where I see younger people getting chewed up by debt is credit cards, buy now, pay laters. It's car loans. It's even novated leases, which is just another form of a loan. So again, a loan is basically any obligation that you've got to pay back to someone else who helped you get that product. So trying to keep your life as free of those as possible, because it protects your cash flow, sets you up to service the debts that you want to hold. So I think having a plan, like I saw some clients earlier this week and they are thinking about buying a home. It was the perfect time. They've got good savings, their cash flow is good, but they're trying to work out, okay, how much could we spend when we borrow to still make sure we have surplus, to make sure we can still live, travel, save, invest, do all the other things, rather than, unfortunately, some people borrow what their maximum and then they try and work it out later. So being proactive and looking ahead and going like, okay, if I had that debt, what would that do? If I had an investment property and it was going to have some negative cash flow, what would that do? So I think managing debt is just about being proactive and assessing it and doing some risk testing in terms of, okay, if interest rates went up by 1%, 2%, what would that look like? And then before you take on the debt, you do it with absolute comfort that it's the right thing to do and that it has clear purpose for you. I think you'll find, like, we talk about debt, and it might be another podcast around like gearing, leveraging, any of those things. They're all about using other people or funds or facilities to leverage your wealth and increase it more quickly. So debt is essential. Like you won't find too many successful people that don't have debt, because they've used debt to leverage and get greater scale of funds or greater scale of access, or expand their business, or even use it for working capital, maybe even getting new staff on board because they need to try and generate more income. So again, debt has many forms and it's powerful, and it's probably one of the biggest wealth creators. It's probably also one of the biggest wealth ruiners as well.
Before you touched on serviceability, maybe if you could just bring that back a little bit and just maybe explain, like, what do actually lenders mean by serviceability, and what are they actually checking about your money habits and what you spend or the debts that you have?
Essentially, they're digging into your life and understanding who you are and what you are, and trying to look for any bad habits in a sense. They'll also use some more generic servicing testing to look at what you could actually afford. So they sort of have a general vibe of what do people in society, in the community, spend if they're a family of two with two kids or a single person. So they've got some generic measures, but they like to check that across what you're actually living off. They're filtering things for like gambling problems or other loans, repayments, or obligations that you haven't disclosed as well. So again, serviceability is nothing to be scared of if you've got nothing to hide and that you are being honest. Most of the time, you can tell what people's serviceability or their cash flow looks like by just looking at their situation. Like if someone rolls in and they say like, yeah, we're good, cash flow is great, and they've got no money in the bank, there may be reasons otherwise, but most of the time it's probably not as good as they think it is. So again, the banks are the same. They're just looking at everything and being your harshest critic about that stuff.
I think the last thing we'll sort of touch on with this one is what's a credit score. We'll just do a sort of summary on it though, because it's something we'll talk about forever. But yeah, just want to touch on that briefly. It's
a good point. So people get very confused about credit scores, and it is a thing. And whenever anyone takes out a loan, or especially with mortgages and stuff, they will do a credit check on you. Now, there's a bit of a myth out there that I think that people think that you need to take on debt to build your credit score before you get a mortgage. If you think about it simply, your credit score is perfect until it's not. So if you've always met your obligations, then you'll have a good credit score. So sometimes people will be like, oh yeah, they just, we wanted to get them, they got a small car loan just to build their credit score. Like that doesn't do anything. Like all you'd probably do is risk eroding it by missing a payment. Every time you apply for credit, so one thing I've seen people get into bad situations is they've gone and applied for like 10 credit cards. Every time you apply for credit, it impacts it impacts the score, even if they don't approve it. It's a big issue for people that get hacked, because what will happen is people get their details compromised. They'll go and apply for credit everywhere, and it will erode their credit score. So it's something to be aware of if you ever do get hacked or anything like that, is you make sure that there's a full process to go back and unwind those things. The bottom line is your credit score does matter, but it only goes downhill if you don't do a good job of paying your debts. Like most of the time you start off with a perfect score until you don't. So it's not something to be super hung up on. It's just something to be aware if you have, for whatever reason, ended up with one. So I've had a few clients where they've ended up with poor credit scores, and it means that they have to pay a higher interest rate on any debt they get, because they've sort of seen as a bit more risk because they've missed obligations in the past. So to be honest, I would think credit score is probably the least of anyone's concerns. It's more about if you have good cash flow, save money, your credit score will not be an issue.
And just finally, just a closing call to action for the listeners. Take control of your financial future. Start by listing your debts today and setting one small goal to reduce them. So thanks, Ben. Thanks for joining us.
Thanks so much.
Thanks, guys. Hopefully not too much jargon this time.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, YouTube, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners to check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decisions, listeners should consider the appropriateness of any information with regard to their particular objective, situation, or needs, and seek advice from a licensed professional specific to their circumstances. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of Acumen Financial Planning, ABN 89051208 327, Australian Financial Services Licence 232706.